Hi, everyone. I'm joined today by Mike Dolson, partner at Felesky Flynn, a specialty tax law firm here in Alberta. And today we're going to go through a few slides to frame out what some expectations of additional taxes moving forward are, and help you with just some sound bites and thoughts around where we've come in terms of COVID-19 and the impact of additional budget spending as a result of that, and sort of a little bit of an outlook of where we might be going. So, Mike, with that, I'll hand it over to you to present your slides.
Great, thanks, Peter. So ever since the start of the pandemic and the beginning of the rollout of COVID-related relief programs, we've been getting a lot of questions about where taxes are potentially going to go, because I think people recognize that at some point all of this is going to need to be paid for. And so I've kind of compiled my thoughts on the situation into a few points. One is just to outline the current situation, and then from there, we're going to look at what some people have been proposing as potential tax responses. So here's where we stand as of right now. The bad news on this slide is that the federal government is currently projected to run a deficit for 2020 alone of about $343 billion. And it seems that number is probably going to go up by the time we get to the end of the year. Some estimates have been as much as $500 billion. And we're probably also going to run very large deficits in fiscal years 2021 and 2022 as well, although probably nowhere near as large as fiscal year 2020. So this is going to have a noticeable effect on our debt to GDP ratio by the time all is said and done. And once you've folded in the projected 2021 and 2022 budget deficits, we're probably going to peak at somewhere around a 63% debt to GDP ratio for federal government debt. So effectively, COVID has undone all of the debt reduction work that happened during the Chrétien-Martin years. And this is all made somewhat more difficult by the fact that the federal government was running a small structural deficit even before the pandemic started, as a result of a couple of spending decisions that were made by the current government. First of all, there was a decision to raise the to lower the OAS entitlement age from 67 to 65, which undid a decision made by the Harper government earlier. And that's going to get expensive later on, as we'll see. While the CCB program that the current government instituted has been extremely effective at reducing child poverty, it's also noticeably more expensive than the programs that it replaced. The CCB is very unlikely to go away, given that it is effective. And so as a result, if the government was planning to return to a surplus, it would have needed to raise additional revenue, even if there was no pandemic. And then finally, about the note on the slide about the provincial governments being in much worse shape than the federal government. This is less interesting from a tax standpoint, since the provincial governments have less latitude to raise taxes, and there's fewer different kinds of taxes that the provincial governments can raise. However, where it becomes very relevant is if the federal government has to bail out the provinces at some point. So, as an example, it seems very likely the federal government is going to have to bail out Newfoundland at some point within the next 10 years. The good news about that is that Newfoundland's debt is so small relative to the size of the federal balance sheet that nobody would notice if the federal government assumed Newfoundland's debt. The bad news is that if the federal government has to assume debt from Quebec or Ontario, that would become noticeable very quickly. This slide is the good news part of the current situation. And to spoil the conclusion, interest rates are so low that borrowing all of this money is probably not actually going to cost very much in the short term, unless the federal government decides that it's going to actively start repaying debt. The alternative would, of course, be to just decrease the debt to GDP ratio using economic growth. And we'll come back to that point in a moment. As you can see on the slide, current federal government interest rates are well below the Bank of Canada inflation target, even on our 30-year bonds. The federal government's interest rates have been falling for the past 40 years. And if countries like Germany are any indication, the federal government's borrowing rates probably have further room to fall before they bottom out. All this additional borrowing does not actually seem to be spooking the market, notwithstanding people speculating to the contrary. We're seeing capital inflows into Canadian government bonds are effectively at their peak level from 2015. So the market still has a demand for Canadian debt. The other good news is that almost all of the federal government's debt is denominated in Canadian dollars. So the federal government has very little FX risk from its debt payments because all the interest is due in Canadian dollars. So falling interest rates have led to this counterintuitive result where the federal government can borrow a lot of money and not cause interest payments to increase noticeably. This is because several $100 billion a year of federal government debt turns over annually and can be refinanced at lower rates as rates fall. So for example, the federal government still has some outstanding long-term bonds with an 8% coupon rate that are going to mature in the next couple of years. And they'll probably be refinanced with 30-year bonds with a 1.1% coupon rate. And if the federal government thought that interest rates were going to spike, they could effectively lock in these rates by converting much of their short-term debt into long-term debt. And so that would be an option as well. Notwithstanding what I may have just said about the federal government potentially being able to afford to take a do-nothing approach, I think the consensus of expert opinion at this point is that the federal government should do something to actually start repaying the debt that it's taking on. This would be prudent in case there is a medium-term economic shock, or in case the federal government does have to substantially increase payments to the provinces or bail out the provinces as their fiscal situation becomes more dire. In the 1990s, spending cuts were the way that the federal government created a surplus that allowed for debt reduction in both real and nominal terms. Spending cuts could theoretically be a part of any go-forward plan too, although I don't have a sense of what would be politically viable there. The one that I have included on the slide is an increase to the OAS entitlement age from 65 to 75, since this was a recent spending decision that was motivated by political considerations rather than economic considerations. It's not a very expensive item right now, but the government projects that by 2030, the cost of the OAS entitlement change is going to be about $9 billion a year due to our aging population. So that's one where a change could, in the future, yield a very substantial savings. The tax change that I think, or perhaps just hope, is most likely to happen is an increase in the GST rate from 5% to either 6% or 7%. I think the elite opinion in Canada has coalesced to a remarkable degree around the fact that the GST is the least economically harmful tax that Canada imposes, and that it raises revenue fairly effectively. A 1-point increase in the GST yields about $9 billion of revenue for the federal government. And yes, as Trevor Toome from the University of Calgary identified, raising the GST to 7% and applying the new revenues to either interest and principal repayments on the debt would take care of most of the COVID-related debt in about 15 years, even if we did nothing else. So it's a very effective tool. It's a very politically unpopular tool, and so the federal government would have extreme difficulty with that. However, I do think the public is probably aware that something has to be done in order to service the debt, and hopefully elite opinion can help push them in the direction of a GST increase, especially since there's a good narrative here as well with the GST that everybody benefited from CERB and CEWS and various other government programs. And so it may make sense as a fairness thing that everybody chips into paying the cost through an increase in the GST. The tax change that wouldn't impact as many people and that gets talked about a lot, probably for that reason, is a change to the capital gains inclusion rate. I'm not as convinced that this one is going to happen. People have been intimating that there's a pending increase in the capital gains inclusion rate since 2015. And I think if there was a market where I could bet against that, I probably would have made a lot of money betting against that tax change by now. However, it's an attractive option. Finance's estimates are even baking in some behavioral response that an increase in the capital gains inclusion rate from 50% to say 75% would bank about $11.5 billion of revenue every year. So it's a very tempting target given the size. That's if you wanted to only make one change that would generate a lot of revenue and you didn't want to touch the GST, that is probably the lowest hanging fruit. The principal residence exemption costs the federal government about $7 billion a year in revenue, and it likely contributes negatively to the housing markets in Toronto and Vancouver. So it is possible, from my standpoint, the federal government could take some action to cap the principal residence exemption at some number and justify it by pointing to the potentially positive impact on affordability of housing in Toronto and Vancouver. But again, that's a fairly unpopular move that they seem to be forswearing. So unlikely to happen there. Canada's rules for interest deductions by corporations are very generous by international standards, as most OECD countries, including the United States, have now capped interest deductions at 30% of EBITDA. Canada could go this route and arguably should go this route. However, the PBO has estimated that capping interest deductions would raise at most $1.6 billion of revenue. So this by itself is not going to get it done. Beyond that, there's a bunch of tax expenditures that cost a lot more than you think. For example, the small business deduction, the capital gains deduction, the charitable donation tax credit, the non-taxation of employer-funded health plan contributions, and zero rating of basic groceries for GST purposes. All of these cost in the ballpark of $3 to $7 billion a year and impose additional costs on the provinces. Although there are solid policy arguments for getting rid of or substantially reforming all of those tax expenditures, again, it's probably unlikely since you would have to bundle several of them together, and all of those tax expenditures are individually very popular. The last point on the slide is a wealth tax, and this has been generating a lot of buzz ever since the NDP asked the Parliamentary Budget Officer to produce a revenue estimate of what a wealth tax would generate. The PBO found that if a wealth tax were set at 1% of wealth above $20 million, the PBO would expect that there'd be about 13,800 Canadian families who would pay the tax, and they would generate about $5.6 billion in tax every year. However, the small number of affected taxpayers means that the behavioral response could be extreme, and the PBO's estimate doesn't account for damages to the income tax system that could happen by some of the gamesmanship that would occur around a wealth tax. Many of these 13,800 people are going to be very close to that $20 million line where the tax starts to kick in. Canada doesn't have that many people who are spectacularly wealthy. And so that means that a lot of people could get themselves under the tax threshold by playing valuation games, for example, by investing in difficult to value assets. So there's going to be a lot of that. And the very small number of people who are extremely wealthy and well above that $20 million threshold, it doesn't take very many of them leaving the country before you get to a point where you're just going to have a huge hit to that $5.6 billion estimate simply because they're no longer around to pay the tax. So I think personally where I land on a wealth tax is that it might be good performatively, but it's probably not a very good revenue raiser. There's been a couple other things kicked around in the tax world as well that you may have heard of, such as digital services taxes, like France, the UK, Italy, Spain, et cetera, are moving towards. Every political party, every major political party anyway, proposed a digital services tax in their 2019 election platform. However, I don't think those are going to happen, given that the Americans have been throwing temper tantrums every time a non-American country has proposed one. So unlikely to happen. As well, there's been the speculation that we would extend the GST to supplies by people like Netflix in order to make sure that people's Netflix subscriptions are subject to GST. That, from what I understand, would have happened already, but for budget 2020 being postponed due to COVID. But no one's expecting that that's going to raise a lot of revenue. So in and of itself, those kind of things aren't really going to move the needle at all. One point that Peter wanted me to touch on was how current tax rates compare with historical tax rates. Since the Mulrooney era, our taxes our top marginal rate for high income payers have generally fluctuated, but they've been within a fairly narrow band between 46.40% and 55 to 59-ish%. So we're currently in the large provinces like BC, Ontario, and Quebec, pretty close to the high point for the last 40 years on personal income tax rates. However, rates were much higher before the Mulrooney era, and especially before the current version of the Income Tax Act came into force in 1972. The 84% top marginal rate in 1949 represented the post-World War II high mark for income taxes. And during the wars, we had rates as high as the 90% for top income bracket taxpayers. So that's where things could go. The potentially obvious implication of this is that the federal government could try to spike rates above the 53.5% cap that we seem to have settled on across the country. I think there would be considerable difficulty in doing so. I think most of you who are watching this presentation are familiar with the Laffer curve and the idea that at some point behavioral responses to taxes become so extreme that increasing taxes generates less revenue than cutting taxes would. This is actually this is a real observed phenomenon. It's just that people disagree about where the peak of the Laffer curve actually is and what that revenue maximizing rate would be. Kevin Milligan from UBC has done some work on this point in Canada, and his conclusion is that the revenue maximizing rate is somewhere between 54% and 69%, which is obviously like an unacceptably broad range. And there's extreme uncertainty about where in that 15-point range the revenue maximizing rate actually is. Given that we're already at the kind of the bottom of that range in the higher tax and larger provinces, it seems unlikely that pushing marginal rates up would actually generate that much more revenue without various changes to how our anti-avoidance rules work in order to prevent behavioral response. So, this is something where the government could go in this direction as a performative measure. But again, it's probably not actually going to be very effective simply because we seem to be pushing towards the point where increasing tax rates won't raise any further revenue. And so with that, I can turn it back over to Peter.
Michael, I appreciate you taking the time to walk us through a bunch of these issues. It strikes me that some of this is predicated on the PBO being able to sort of accurately assess what the deficit is going to be. And recently, just I think in the last couple of days, the Parliamentary Budgetary Officer has said, if this continues to go on, if we continue to have to spend on pandemic-related expenses, or frankly, if our revenues are reduced because companies are producing less tax, people are producing less tax, structurally, we're going to have a bigger challenge on our hands. The reality is that nobody really knows what the future holds, but the other reality is you're unlikely to see a tax-based response until that forecasting becomes clear. Is that fair to say?
I think that's fair. I think that there's been a lot of speculation that maybe when Parliament resumes sitting in the fall, there's going to be a fiscal update and maybe there'll be some tax changes then. And I don't think so. I don't think that's likely. I think because any material tax change is going to raise a lot of revenue is going to have an impact on the broader economy. And until the broader economy stabilizes, we're not going to be able to figure out what that tax increase is going to do in terms of non-revenue effects just on economic performance. And so yeah, I think things are going to have to settle down. And once we've kind of observed the carnage, then I think the federal government will have a better idea of what they want to do in terms of addressing it.
Do you spend any time with your clients sort of thinking about the idea that, a tax is a tax? If they tax highest marginal, or they tax or implement higher GST, or ultimately that's money coming out of your jeans, so to speak, and into the federal coffers. When you're sitting down and planning, do you give that any consideration? In that, there may be taxes that you can spend more time strategizing around than others. I.e., it's difficult to strategize around GST because that's a consumption tax and really going to be, up to the client to think about how much money they're spending, versus maybe highest marginal, where there may be some different solutions to think around in terms of how to plan for that. Is that fair to say?
Absolutely, yeah, that's very fair. I think you nailed it on the GST. Basically, nobody does very much to plan around it, especially in Alberta where the rate is 5%. It's generally not worth the effort to try to avoid the GST. What on the income tax side? Yes, absolutely. There's lots of games that can be played in terms of deferring personal income in favor of corporate income, on converting income into capital gains or into dividends, for example, to achieve better rates, and just in ways to, for example, multiply the small business deduction or preserve the small business deduction to get a better rate, to ensure a better rate on investment income. Instead of having to get into the refundable tax regime that we normally have for CCPCs, to get out of that regime. Those kind of things, all very popular, lots of that. And the other thing that we're starting to see people do is that because people are looking at the current fiscal situation and are starting to worry about increased tax rates, we do have clients now who, because interest rates are so low, are willing to prepay tax in order to lock in the current rates. So when if you're thinking that you're going to have a sale next year, for example, and you don't know what the rate is, and you don't know what anti-avoidance rules might be enacted between now and then, you might want to take measures to realize your capital gains this year using structures that defeat the CCPC investment income regime in order to lock in that rate so that you know how you're going to be taxed, especially if your tax rate matters to your decision to sell an asset, for example, or not. So yeah, there's been a lot of that kind of planning.
And then last question, a tax that was already enacted that I think's been quite unpopular for business owners has been the passive income rules. Do you see much in terms of clients coming in looking for solutions or looking for strategies to manage their passive income wealth that they would have accumulated inside of a corporation that is now going to be taxed more aggressively?
Yes, we do see some of that. It's obviously primarily been for people who are trying to preserve their small business deduction, and there's quite a bit of that. For many people, especially those who are married and have pretty confident in that their marriage is going to last, it can be done through reorgs in terms of just spinning assets out. If you're very careful about how you do it, obviously, because there are anti-avoidance rules. But for people who want to keep everything in the same corporation or have to keep things in the same corporation, yeah, there's absolutely a demand for that. And if you don't have, if you can't spin out assets to your wife, for example, it does become very difficult to avoid those passive income rules. And but there is absolutely some pent up demand to do that.
Michael, I want to say thanks again. It strikes me that if our clients have tax planning issues, specifically around corporate tax planning issues, you would be someone who our advisors may consider reaching out to or introducing their clients to. We've got some contact information on this slide. I just want to thank you for your time today. Thanks, Michael.
Absolutely. Thanks for having me.